What's going on? Welcome back to the channel. So today when I talk to you about BioStem Technologies, I want to go over what this company is all about and why you need to really add them to your watch list. Before we get into any of that, make sure you guys hit that thumbs up. And with that, let's get right to it. So starting off, ticker is BSEM, sitting at 485. Today, it just hit a new 52-week and all-time low at 476. In my opinion, I think it is largely getting overlooked just because it is a OTC stock. But it does also have lower volume. So today, roughly around 78,000 shares being traded. Historically, we can see with a little bit of volume, it can easily run up a good 30-40%. So just because it's hitting 52-week lows, in my opinion, doesn't really mean all that much. This is what they do for the company profile, so feel free to pause it and read through it. This is the description from their website, which again, for those of you that haven't traded any OTC stocks, normally you don't actually have a good functioning website, but this has tons of information, so highly suggesting popping over there to kind of take a look. But there's a couple big catalysts that is coming up that I wanted to share with you. So even more reason why you need to add them to your watch list. But typically, I love when insiders buy. So this just came out August the 21st, and it did signal that the CEO bought stock. So it does show that they bought $15,500 on August the 19th, roughly $100,000. It was split into two transactions, one $2,500 at an average of $628, the other one being $13,000 at $651. Again, going back over to the price, we are sitting at $485. So they saw value at that $6 range, so between $650 and $628. They saw it advantageous to buy. They do currently own about 1.1, just over that million shares. So obviously they believe in this stock. So everything about this is like positive to me. And normally when I see this, it's an instant green flag, right? Because typically they buy if they see value. So again, definitely something to take note of. Of course, I know OTC stocks aren't for everyone, but they are wanting to uplist to NASDAQ. So you can kind of see that they have put multiple different requests in. So I know this process has really slowed down quite considerably. So the last update did come June 3rd, 2025. So most likely, this should be coming out sooner rather than later. A lot of stocks that even I've invested in the past, I went OTC to NASDAQ, it took them almost about a year and a half. So again, based on the timing of this, which it showed that they submitted their first Form 10 September 2024, we are getting close to that year and a half mark. So again, if they do uplist to the NASDAQ, a lot of institutions will be buying it because of that, adding a lot more liquidity and in theory, really pushing it higher. So this also is another big catalyst that should be coming out sooner rather than later. And then over and above all of that, you also do have this right here. So this study, so the BRACDFU 101, so this one came out June 23rd, 2025, and the full data is expected to be Q4 2025. And so we'll be able to find out exactly how things went and if they're going to pursue that. But nonetheless, this is also typically another big catalyst for biotechs. So again, there's three catalysts that is one that passed, of course, the insider buying, but two coming up that could easily push this stock higher. And even going back over here, so Seeking Alpha has a pretty complex quantitative data stack right here, where it goes over valuation, growth, profitability, momentum, and revisions. Right now, analysts haven't really paid attention to it, so that's why Wall Street, this show is not covered. That's why also for revisions, we have D-, F, and C, because it's not really relevant. Momentum is an F, and to be fully honest, based on the stock price performance, I kind of tend to agree with, but the valuation, growth, profitability, all A+, A, and A. So if for those of you that are value investors and see a lot of good upside potential and like to kind of look at what's coming up for catalysts, this stock has everything. But one thing I do want to share with you though is that they did recently participate in a event, a healthcare conference, so the Morgan Stanley 23rd Annual Healthcare Conference, and that was on September the 10th. In here, and on a side note, I'm going to play this at the end. It's roughly around 15 minutes for those of you that are interested. But nonetheless, in here, you do have the CEO saying that because of the whole partnership that happened in, looks like 2023, there was about 16.9 million of top line revenue. In 2024, there was over 300 million. So going back over here for 1 second, you can see just the market cap is sitting at 83.05 million. So everything is signaling that this stock is at a crazy discount, and it's not getting manipulated by shorts, because quickly going over here, only 1.16% of the free float's being shorted. It is just simply institutions not really buying it, or possibly just kind of swing traders or whatever else. But this stock definitely does have a lot of good upside potential and needs to be added to your watch list. And briefly, I know with lower volume, sometimes you can't really pay attention to the technicals as much as you probably would ideally like, but coming from this standpoint, this is why it's gone down, because looking at the market position, you don't really see that much buyers. So, and it's been kind of the case for a very long time. Kind of changed a little bit when it started to move higher right here, but it's just not really that much buyers. But potentially with those good catalysts and a little bit of volume, you could easily see a nice push higher. So let me know your thoughts on this stock. Definitely worthwhile to, like I said, add it to your watch list. I'm going to play this right here. So for those of you that are interested, I think it's quite advantageous. So again, kind of tune in and let me know your thoughts on this stock. With that said, I appreciate all of you watching.
Let's kick off. I'm Dennis Keller, Vice President with Morgan Stanley. Happy to be hosting BioStem. With us today is 𝗖𝗢𝗡𝗡𝗖𝗧, CEO. Before we dive in, I just want to note for important disclosures, please see the Morgan Stanley Research Disclosure website, morganstanley.com, research disclosures. If you have any questions, please reach out to your Morgan Stanley sales rep. With that, let's get started. Thanks for being here, Jason. With some investors maybe not up to speed on the company, can you spend the first minute or two just giving us a quick overview of the company and your core technology?
Sure. So first and foremost, thank you, Dennis, for having us here. Really appreciate first opportunity to speak at Morgan Stanley Global Healthcare Conference. So great opportunity. So BioStem Technology. So we are a profitable medtech company focused in advanced wound care. Our core technology is BioRetain. It's a proprietary technology that we process placental-based tissue allografts for the advanced wound care space, specifically looking at treating diabetic foot ulcers, pressure ulcers, and venous leg ulcers. This patient population is roughly about 7 million Medicare beneficiaries and a total market of about $11.3 billion in advanced wound care space.
Great. What is the BioRetain process exactly, and how would you compare it to alternatives in the market?
Yeah, I think it's definitely differentiated. We've published some real-world data so far on the BioRetain process. We actually retain a large portion of the natural elements of the tissue, including the extracellular matrix, some of the growth factors and cytokines that are naturally found in placental-based tissue. And as I mentioned earlier, our real-world data has demonstrated that with the BioRetain process, these allografts have supported less number of applications to close a wound, as well as less time to close a wound.
Can you help us understand how you think about the addressable market today with the existing portfolio and how that could expand over time as product is developed?
Yeah, I think right now it's call it the wound biologics TAM is roughly about $11.3 billion in the advanced wound care space. I think when we look at other areas of focus for BioStem, we're looking at areas like hospital outpatient, surgical OR suites, and things of that area where we could actually focus on leveraging our core technology of BioRetain to those areas, as well as looking at synergistic M&A opportunities to target those areas as well.
Help us understand the clinical data portfolio of the company, kind of key highlights from the clinical trial data set at this point.
Yeah. So right now we're actively running 3 RCTs. We just finished enrollment in our first DFU study. Roughly 72 patients enrolled across 10 sites. We're looking to report out data on that DFU study later this year. And then we're also enrolling patients in 2 additional studies, one in the VLU or venous leg ulcer space, same number of sites, roughly about 10, and similar patient population size, about roughly 60 patients. And then a secondary DFU study on our amnion, our BRAM trial, which is just solely focusing on the amnion layer of the placenta. Similar size trial, roughly 60 patients across 10 sites. The last two trials we're aiming to get readouts kind of the beginning of mid to next year on those two trials.
Great. I guess pivoting to the partnership with Venture Medical, it's been a key driver for the business. Can you help us understand kind of just at a high level what the partnership brings and how we should think about the partnership on a go-forward basis?
Yeah, I think the partnership has been instrumental in our growth. Definitely a story from 22 to 24. 23 was roughly about 16.9 million top line revenue, 24 over 300 million. So we entered into that partnership with Venture Medical in late 23. The partnership really represented both their recognition of our BioRetain process and the product portfolio, and they really realized that this is a differentiated product line for the advanced wound care market, as well as when we saw in Ventures, they've developed a software platform called OneView, and we felt that that was a really amazing platform to support providers, not only from a compliance perspective, but also from a cash flow management perspective on managing where claims are and how to appropriately process those claims and really help and support those providers, especially when we're talking about their core focus in the mobile wound care segment as well as physician office segment. Those are areas where they're smaller groups, right? They're not institutional like hospitals, large organizations, where they have the infrastructure to support that cash flow management side of the business, as well as the compliance side. So I think it was a really good synergistic opportunity between both groups. We kicked off with over 100 FTEs into the field on day one, so the opportunity to really scale very quickly with the commercial team on day one was a great opportunity. They came over from an existing product line as well, placental-based tissue product line. So it was a quick study for their reps and their team to get out and go to work. And so, kind of which led to the success of 2020, late 23 and into 24 and where it is today.
Excellent. And as you think about your commercial strategy on a go-forward basis, what are kind of the puts and takes relative to going direct versus your distribution channel?
Yeah, I mean, I think, obviously, which we haven't really got to yet, is some of the headwinds around reimbursement and some of those struggles, but or opportunities, I should say, coming forward. But I think when we look at the model with Venture Medical and the opportunity that we've had in exclusive partnerships to really capitalize on the mobile wound care segment, physician office segment, as we go into 26, I think some things may change in regards to how we look at commercializing the product. We are looking to internalize some of the commercial team on the core focus in hospital, OR, and in the federal space, so VA, DOD. But I think the hybrid model where Venture has really demonstrated their knowledge and success in the mobile wound care segment will continue to leverage that partnership and continue to hopefully flourish.
Now, a good segue to reimbursement. Proposed changes to CMS or PPS fee schedule, which were published in mid-July for skin substitutes. So some uncertainty around the final pricing for the products. What will the competitive landscape kind of look like moving forward? And can you share just kind of your perspectives on what these changes mean for you short term and maybe medium term from a market opportunity perspective?
Yeah, sadly we only have 27 minutes left, so it's a long topic for sure. It's somewhat contested. I mean, there's a lot of changes potentially coming up, but I think ultimately these are good changes, right? I think this administration, along with leadership at CMS and HHS and even, frankly, even in the medical community, KOLs in the space like Dr. 𝗖𝗢𝗡𝗘𝗖𝗧 and others have really kind of called out and said, look, there needs to be reform here. I think we have a runaway spend, specifically utilizing the ESP +6 methodology that products are being priced at in the physician office and mobile wound care space. Which aren't really tied to kind of the payment structure that we find in HOPD and ASC, where it's a bucketed rate, right? And so this new OPPS and PFS physician fee schedule and outpatient physician fee schedule are trying to align those things. So we have a kind of continuous payment methodology for product across all sites of service, and looking at, kind of where we end up with specific placement reimbursement outside of product. It kind of gleans towards more of the traditional pass-through methodology that you've probably seen in the past. And I think it's going to hopefully normalize this industry. I know wound care has been a struggle on ever-changing dynamics around reimbursement, and I'm hopeful that ultimately we see a normalization past 26. I am a little concerned about the low initial price that they propose, about $125. I think that ends up being a challenge for mobile wound care providers to service patients that are in underserved communities, or rural areas where they don't have access to get into a clinic and need that mobile wound care provider to get out to them and treat their wound. And so, I'm hopeful that we see a price increase from that 125 number, and we'll be actively commenting through the comment process. I think it ends on the 12th, so near term here, and hopeful to see what the outcome is in November as well on the final price for effective Jan 1, 26.
And as that process kind of moves forward, can you help us think through milestones such as clinical data and where you could have kind of more visibility for reimbursement that could come into effect at that time?
Yeah, I mean, I think, for us, we're in a new position, right? Because we do have clinical data coming out back half of this year. I think that will help substantiate our differentiation in the marketplace and say to folks, hey, we are a leader in this space, right? We're committed to this space. We're committed to investing in the clinical trials to demonstrate superiority of our product. And I'm hopeful that, kind of driving that clinical data along with other initiatives, that it creates more of a long-term initiative for our organization. So.
Great. I guess pivoting to the business, in the first half of 2025, you reported $1.8 million in revenue, which is up 5% year on year. Can you break down kind of the growth drivers in terms of expanding accounts, driving higher utilization with your existing users?
Yeah, a combination of both. I think we saw some good utilization within existing accounts, and frankly, looking to expand into areas geographically. Venture Medical is kind of core to the West Coast, west of the Mississippi, and we're looking to target some of the East marketplace for these products, and really trying to partner with really more sophisticated long-term partnership as we kind of bridge from this ASP plus 6 methodology into the new methodology, and really looking for mobile wound care providers, specifically on the venture side, as well as physician office folks that want to be here long term, and it would be great partners that really value the technology and value how BioRetain supports their patients in closing wounds. And so we're kind of looking forward to kind of seeing where that growth goes and continues to grow. I think there's other opportunities for us, specifically from a growth driver perspective, that come where, maybe M&A opportunities come along, or other areas to diversify into other segments, like I alluded to earlier in the hospital outpatient and the OR space.
As you think about, current product suite, some of the selling points that are most attractive to the clinical community, could you kind of walk through some of those?
Sorry, can you answer?
Yeah, so some of the selling points of the products that are most attractive to the clinical community.
Yeah, I mean, obviously the BioRetain process is definitely very attractive to them. I think what they've seen, at least initially on the real world data, is like I kind of alluded to earlier about less number of applications and quicker time to heal on very hard to heal wounds. That's very attractive to providers that really, want to utilize a product that's going to get some of these hard to heal wounds. I think even frankly, it's great to hear testimonials from providers that say, hey, I've been using a synthetic product or another competitor product. I've been trying to treat this patient. We're going on 12 months, 18 months. We still have not gotten this wound closed. and we were able to use your product in 3 or 4 applications to get the wound closed, right? It's extremely satisfying and great, gratifying in a way, right, to hear that. So it's kind of cool.
Yeah, it seems like if you have those kind of referenceable proof points, you use those with the next center and kind of keeps giving.
Yep. Yeah, and I hope, going forward on, at least, with the readout of the RCT, that will also be more of a validating point, right? Some of these real world data sets, or real data patients aren't as compliant as when you're running a clinical trial, right? So getting a patient to be compliant is some of the biggest challenge in wound care, right? Getting a patient to come in, offload, do some of the things that are necessary for a proper blood flow and making sure that they're not continuing to propagate a wound. When you're in a more rigorous clinical trial, it's a lot easier to kind of hold some of those variables a little closer. So,
and that's even for the DFU and the VLU.
Yeah, absolutely.
Interesting. So, I guess stepping back, can you help us think through the growth trajectory over the next few years?
Yeah.
For the company.
I think obviously going into 26, we'll kind of have a reset based on the framework of reimbursement. But I think that will also lend itself to really get some clarity around what does growth look like over the next 4 to 6 years. I think for us, we'll continue to kind of drive adoption of our existing BioRetain platform in the mobile wound care space, hospital outpatient space, look to start getting involved onto GPO agreements, IDN agreements into the hospital setting, and look at other sites of service within, or frankly, call points within the hospital system, not so focused in chronic wound, but more, gravitating for some of the acute wound space as well. I think there's a lot of M&A opportunities within this space as well. I think values are suppressed and some really nice targets that will kind of expand what I always say is the continuum of care, areas where we don't have a product that touches a patient across that value stream, and where we are currently kind of at the end of that continuum of care where all these other products didn't work on that patient and we're a product of last resort. It'd be great to have an opportunity to expand our product portfolio and be able to service a patient on day one and hopefully on day wound closure.
Really exciting. How would you evaluate where you are from a market share perspective now, and then where do you expect that to go over time?
Yeah, no, it's a great question. I mean, as I kind of alluded to, it's $10.3 billion. It's a very large market. We delivered just over $300 million last year, so somewhat small and de minimis, I guess, in the overall market opportunity. But I think, like I said, we'll see how things suss out, moving forward from 26 and how that changes not only the TAM, but also, who's left and who's interested in being a long-term player in this space. We'll continue to try to drive the BioRetain message, and as I alluded to, getting into the hospital and things of that nature hopefully drives that as well.
I guess, if you look at it slightly differently, how many relevant accounts are out there? How do you expect to kind of incrementally penetrate those accounts over time, recognizing the backdrop?
I think ultimately, as I kind of alluded to too, is roughly about 7 million Medicare patients out there with a chronic wound, and so that number is growing exponentially as well. So the problem isn't going away. I think when we look at how many patients we ultimately are not currently addressing right now, just due to the market dynamics of high ASP products and other things, I think there's still a decent amount of market opportunity in the mobile wound care physician office segment, as well as kind of a green field for us because we're not in the hospital yet, and we know that market is pretty sizable based on the success that some of our peers are having. So I think there's a lot of upside for us in a lot of areas.
Just shifting to the financial profile, specifically gross margins, they're obviously very strong at 95%. Can you help us better understand the manufacturing process and the pricing strategy that helps you drive that type of margin?
Yeah, I think it screams why buy or retain is superior, right? Not only from a superior product of retaining a lot of the natural properties, but also the fact that it's a very efficient process to manufacture. We look at competitors and kind of evaluate how do they actually process that material, and it's taking them anywhere between 8 to 10 hours to process that material. We've been able to develop a process to manufacture that product within, sub 3.5, 4 hours. So almost half the time. At the same time, we're using the method in which to retain a lot more of the natural property. So, not only are we maximizing efficiencies on the manufacturing side, but also it lends itself to a better clinical product. So pretty cool.
Really exciting. And then moving down to operating margins, those are kind of in the low double digits. Can you talk about the path forward around the operating infrastructure in terms of investments you'll need to make to continue supporting, on one hand, the clinical evidence generation, on the other hand, the commercial growth?
Yeah, I think the operating margins continue to kind of be in these low double digits numbers, at least kind of going forward as we invest in clinical infrastructure, manufacturing infrastructure for scale as we kind of go forward. Hopefully as kind of those things kind of run their course, we can hopefully create some efficiencies there. I think when I look at also EBITDA margin and some of the sales and marketing as a percent of revenue, I think when we get past the end of 25 and go into 26, there will be an opportunity to also improve some of the efficiencies there as well. And that's kind of why we're really excited to see how things kind of pan out in 26. There's some efficiencies there that we can pick up as well, and frankly be a little bit more similar to our peers in some of those percentages and whatnot.
It sounds like it translates into a fair bit of operating leverage on the P&L. I think you hit this earlier, but just to kind of maybe double click on the types of M&A opportunities that are coming your way and how you might look to allocate company resources to achieve inorganic growth. I think there's, like I kind of alluded to earlier, I think there's definitely some opportunities in areas that, I think there's orgs and product portfolios out there that really aren't large enough for the larger folks like a Smith & Nephew or a Zimmer or Molecule to take on, and they're also too close in synergy to the existing peers. And so because we are lacking access into the hospital and the OR and things of that nature, I think there's some really good opportunities there where we can pick up products, frankly, people, other organizations that help us accelerate our opportunity, just like Venture did when they showed up and showed up with 100 FTEs in the field in 23. We were able to kind of lock and load and go forward and commercialize very quickly. I think there's other opportunities in areas that we don't service now that we can do something very similar. And how does it commercially look like if you're looking at targets and you're thinking about chronic versus acute wounds? Is that a different call?
No, absolutely. Yeah, I think it is. And then I think to also kind of expand on your question or point there is, when we look at things and we're looking at things that are, positive revenue generation, positive EBITDA generation, so not really a science project or anything like that, something that's more mature and definitely has a good footing that we can add capital to and resources to and really grow it from there.
I guess as you look out, there's obviously some exciting readouts with DFU and VLU. Does that change your approach commercially as those kind of come on the market?
Yeah, I believe so. I mean, I think, we'll see where the coverage policy goes. We have this looming also local coverage determination that, we'll see how that impacts what clinical data is going to be required to effectuate, being on the covered versus non-covered list. When CMS ultimately pushed the LCD back to January 1st of 26, one of the things they mentioned was, hey, organizations, please submit data for your products in November. by November. And so we're actively going to work towards that. And I think, expanding on how do we get access in more commercial payers, or frankly, just better product adoption, just due to the fact that providers see the clinical value of these products. I think the other side of that coin too is the fact that when we move away from ASP plus 6 methodology and move more to a normalized pricing structure, there'll be more on selling on efficacy and product adoption around efficacy and the science versus economics, hopefully.
And I guess on that note, there's the Journal of Wound Care had an interesting article recently kind of addressing the policy framework for skin substitutes. Just curious if you had a chance to take it in and what the implications might be. I know you touched with the 125 earlier.
Yeah.
It's not sustainable, but
yeah, I think JWC and Dr. 𝗪𝗧𝗛𝗧 and that group did a great job of really combing through the CMS data, right, and saying, okay, hey, are there things that we need to be looking at? Is there anomalies in the fact that are we, no pun intended, throwing the baby out with the bathwater here, in the sense of, are there a subset of providers that are overutilizing these products? How many other providers are utilizing these products? And are we getting better adoption, meaning more patients are getting treated? Or is there just overutilization by maybe bad actors and things of that nature? And I think that paper really highlighted the fact that there's a significant amount of adoption of these products by the top 100 providers that are utilizing these products. Also, I think it was fascinating the fact that there is a significant delta between DFU and diabetic foot ulcers and venous leg ulcers on how much product is needed to treat those patients. One thing that is also fascinating that isn't really covered by the LCD is the fact that pressure ulcers were left out of the LCD. And so I kind of scratch my head and go, okay, well, why is that, right? And kind of look through some of these things and realize, wait a minute, there is no clinical data for treating pressure ulcers by these products. And so maybe that was the driving factor around that, And so Bill and his team, I think, did a great job on putting together a good summary around what does it take to be successful in utilizing skin substitutes in the mobile wound care space, in the physician office space. What does that number really need to be from a reimbursement perspective? Do we need to normalize placement rates across all sites of service so that we don't have an artificial drive to one site of service or the other if we're going to normalize pricing across all sites of service? It's a good read. I wish everybody would take a time to to read it, because it's a very easy one, and I think it lays it out very nicely as to kind of what are the hot buttons in this industry, but also what are the pretty, I feel like, tangible solutions that could be that could solve a lot of the hopeful, the fraud and abuse and some of the other issues. So.
Great to have you here, Jason.
Yeah, no problem.
Thanks so much.
Yeah, thanks so much.